Credit Research Interview Preparation Guide. If you are preparing for credit research roles on the sell side or the buy side, this video is built exactly for you. We have created very comprehensive interview preparation material specially designed for credit research teams, not equity-style storytelling or surface-level ratio discussion. In this session, we go deep into how credit analysts actually think, from default risk and liquidity analysis to capital structure, covenants, recovery, and credit spreads. You will learn how interviewers expect you to evaluate downside scenarios, cash flow durability, leverage sustainability, and what happens when things go wrong, not just when business is strong. And explain the role of a credit research analyst and how it differs from equity research. A credit research analyst focuses on a company's ability to repay debt. Your goal is simple but demanding. Assess default risk and recovery potential. Equity analysts study the upside of the business, growth, margins, and strategic positioning. Credit analysts study the downside, cash flow stability, leverage, covenants, and capital structure. Equity investors care about earnings. Credit investors care about survival. Walk me through the key components of a fundamental credit analysis. You begin with business risk, industry structure, competitive strength, and cyclicality. Then move to financial risk, leverage, coverage, liquidity, and cash flow. Next, assess event risk, acquisitions, litigation, regulatory action. Finally, evaluate capital structure, covenants, and recovery prospects. A complete credit analysis blends quantitative ratios with qualitative judgment. Describe how you evaluate a company's ability to meet its debt obligations. Start with cash generation. Strong free cash flow is the lifeline of credit. Next, check the timing of obligations, interest payments, amortizations, and maturities. Then assess liquidity, cash on hand, revolving credit, and access to markets. If cash flow covers obligations comfortably and liquidity sources are reliable, the borrower is stable. What financial ratios are most relevant in credit analysis, e.g., leverage, coverage, liquidity, and why? Credit analysis leans on three ratio families. Leverage ratios, such as debt to EBITDA, measure indebtedness relative to earnings power. Coverage ratios, such as interest coverage, measure how easily earnings cover interest. Liquidity ratios, such as current ratio or free cash flow, show short-term resilience. These ratios explain how stretched, how safe, and how liquid. The borrower is 1. How do you assess a company's capital structure and maturity profile? You map all debt instruments, revolvers, term loans, bonds, convertibles. Then build a maturity schedule showing when obligations come due. You look for refinancing risk, bunching of maturities, or reliance on fragile markets. Good structures have staggered maturities and strong liquidity buffers. A poor structure can trigger distress, even when the business is healthy. Explain the difference between investment-grade and high-yield credit risk. Investment-grade issuers have stable cash flows, moderate leverage, and low default probability. High-yield issuers carry higher leverage, weaker cash flow visibility, and meaningful event risk. Investment-grade focuses on downside protection. High-yield focuses on avoiding default and maximizing recovery if things go wrong. Walk me through how you analyze a bond's covenant package and why it matters. Covenants protect creditors. You read them carefully, line by line. You assess limits on leverage, restrictions on asset sales, permitted liens, and rules on dividends. Weak covenants allow shareholders to extract value at creditors' expense. Strong covenants improve recovery and reduce downside risk. They matter massively in high-yield credit. Describe how you perform scenario analysis for credit risk, e.g., recession, commodity shock. Start with a base case model. Then stress key drivers, revenue, margins, working capital, capital expenditure. You ask, what happens if EBITDA falls by 20%? Do liquidity sources hold up? Do coverage ratios remain above thresholds? Scenario analysis reveals vulnerability before it becomes visible in actual results. A company's EBITDA declines while leverage remains constant. What could explain this? Leverage equals debt divided by EBITDA. If EBITDA falls but leverage stays flat, then debt must have decreased, likely through repayments or asset sales. Or accounting adjustments may offset the decline. For example, add-backs or restructuring changes. You investigate whether leverage is truly improving or simply appearing stable. Explain how credit ratings are assigned and what factors drive upgrades or downgrades. Rating agencies follow a structured process. They evaluate business risk, financial strength, industry outlook, and event risk. They score leverage, coverage, liquidity, ESG factors, and governance. A committee then reviews the analyst's recommendation. Upgrades come from sustained deleveraging and stronger cash flows. Downgrades follow weak performance, rising debt, or large risk events. Describe how you analyze a company's cash flow statement for creditworthiness. Start with cash from operations. Is it strong and consistent? Then check capital expenditure, growth versus maintenance. Next, examine free cash flow after capital expenditure. You look for reliance on financing. Repeated new borrowing is a red flag. Healthy credits fund operations internally. How do you interpret trends in interest expense, refinancing needs, and liquidity risk? Rising interest expense may signal higher leverage or worsening credit spreads. Refinancing needs show whether the company depends on capital markets. Liquidity risk grows when cash balances fall, revolvers are drawn, and maturities bunch together. You build a picture of how the company handles both normal markets and stress periods. Explain how industry cycles influence credit spreads and default risk. In cyclical industries, such as autos, energy, or airlines, credit strength moves with economic cycles. In downturns, spreads widen because default probability increases. In recoveries, spreads tighten as earnings stabilize. A good analyst anticipates these cycles, not just reacts to them. A company announces a large acquisition funded by debt. What are the key credit considerations? You evaluate leverage jump, integration risk, synergies, and the timing of cash flows. You ask whether the deal increases scale and stability or creates strain. You also study covenant impact and rating agency views. Debt-funded deals often create temporary credit deterioration. Sometimes the deterioration becomes permanent. Walk me through how you model a company's probability of default using quantitative methods. You may use statistical models such as logistic regression or structural models like Merton. Inputs include leverage, coverage ratios, equity volatility, interest rates, and market spreads. The model outputs a probability of default curve: 1 year, 3 years, 5 years. You test the model, challenge assumptions, and stress the inputs. How do you assess recovery rates for different types of debt instruments? Recovery depends on collateral quality, seniority, and jurisdiction. Senior secured loans recover more. Unsecured bonds recover less. Subordinated debt recovers least. You study historical recovery data, asset values, and covenant protections. Recovery rate matters because credit losses equal PD times LGD, loss given default. Explain the structural hierarchy of claims in bankruptcy: seniority, secured versus unsecured. At the top sit secured lenders. They have claims on specific assets. Next comes senior unsecured lenders. Then subordinated lenders. Equity holders sit at the bottom, and often receive nothing. Understanding this waterfall helps you model expected recovery for each instrument. Describe how you evaluate collateral quality and coverage. You examine the nature of the collateral: real estate, machinery, receivables, inventory, or cash. Then assess its liquidity and market value. Coverage equals collateral value divided by secured debt. High-quality, liquid collateral improves recovery. Weak collateral adds uncertainty. How do you analyze covenant headroom and forecast potential breaches? You start with covenant ratios, for example, maximum leverage or minimum interest coverage. Then, project these ratios under base and stressed scenarios. Headroom equals the difference between projected values and covenant thresholds. If headroom is thin, you highlight breach risk and potential renegotiation needs. A bond trades at a steep discount. How do you determine whether it signals distress or mispricing? Steep discounts can mean distress, but sometimes the market overreacts. You analyze upcoming maturities, liquidity position, industry pressure, litigation, covenants, and management credibility. If fundamentals do not justify the discount, it may be a mispricing opportunity. If fundamentals explain it clearly, the discount signals genuine risk of default or restructuring. Hashtag credit research, interview preparation. Part 2, questions 21 to 40. Teacher style, slow pacing, clear logic, natural pauses with the. This continues directly from Part 1. Hashtag. What is the role of credit spreads and how do you interpret their movements relative to equity performance? Credit spreads measure the extra yield investors demand to hold a company's debt instead of a risk-free bond. When spreads widen, markets are pricing higher default risk or lower liquidity. When spreads tighten, markets show confidence in the issuer. If spreads widen while the stock price rises, you may be seeing a divergence. Equity markets expect growth, while credit markets fear deterioration. Credit analysts investigate these mismatches because spreads often react earlier to solvency concerns. How do you compare credits within the same sector but different capital structures? You normalize the analysis around risk to the creditor. First, compare leverage and coverage. Next, compare seniority. Senior secured loans behave differently from subordinated notes. Finally, compare business profiles and event risk. A company with low leverage but weak covenants might be riskier than a higher leverage peer with strong protections. Capital structure determines where losses fall in a downturn. Explain how macroeconomic trends, inflation, rates, FX, GDP, influence corporate credit risk. Macroeconomic forces shape revenue, margins, and borrowing costs. Inflation can erode margins if a company lacks pricing power. Higher interest rates increase interest expense, making leverage harder to manage. FX movements create volatility for global companies. GDP cycles influence demand and default rates. Credit analysts translate macro trends into revised forecasts for cash flow and leverage. Describe how you analyze management quality from a credit perspective. Credit analysis focuses on discipline rather than bold strategy. Strong management shows predictable execution, conservative leverage targets, and transparent communication. Weak management pursues highly leveraged deals, inconsistent guidance, or aggressive accounting. You observe capital allocation history. Past decisions reveal true behavior. How do you evaluate event risk, including LBO risk, litigation, regulatory changes? You test whether the company is a target for a leveraged buyout. For example, stable cash flow and low leverage may attract private equity. You assess litigation exposure, potential fines, or compliance costs. For regulatory changes, you quantify operational and financial impacts. Event risk can shift credit quality rapidly, so you always maintain forward-looking scenarios. Explain how recovery cascades differ between senior secured loans and unsecured bonds. A recovery cascade is the order in which creditors are repaid after default. Senior secured lenders claim specific collateral first. They receive proceeds from asset liquidation until their claims are covered. Unsecured bonds sit lower. They only receive residual value once secured claims are satisfied. This structure leads to higher recovery expectations for secured lenders and materially lower recovery for unsecured creditors. A company refinances short-term debt with long-term bonds. How does this affect credit risk? Refinancing short maturities reduces near-term liquidity pressure. It smooths the maturity profile and lowers the probability of default. But if long-term bonds have higher interest rates, interest expense may rise, impacting coverage. Overall, extending tenor is usually credit positive, unless the added cost strains cash flow. Describe how you perform liquidity stress tests for credit analysis. You start by projecting cash inflows and outflows under severe conditions. Then apply stresses such as revenue drop, margin compression, working capital outflows, limited access to capital markets. You check whether cash and revolver capacity can support operations for several quarters. Liquidity stress tests expose vulnerabilities before defaults occur. Explain how you compare credit metrics across peers of different sizes or accounting standards. Use ratios rather than absolute numbers. Leverage, coverage, and liquidity scale naturally across companies. Adjust for accounting differences. IFRS versus US GAAP. By normalizing EBITDA, lease treatment, and extraordinary items. Also, consider business model differences. Large companies may handle downturns better due to scale. Your aim is comparability, not mathematical precision. Walk me through the components of a comprehensive credit research note. A strong note includes investment recommendation, company overview, industry context, fundamental analysis, financial forecasts, capital structure review, covenant analysis, valuation and spreads, key risks and scenarios, recovery and downside cases. The note must be concise but thorough, telling a complete, defensible story. A company's credit rating stays unchanged despite weaker fundamentals. How do you interpret this? Ratings are often slow-moving. Agencies wait for confirmation before acting. This lag means the market, credit spreads, and bond prices may reflect deterioration earlier. You treat stable ratings with caution during weakening conditions and rely more on your independent analysis. Explain how ESG factors affect credit risk and spreads. ESG affects long-term solvency and reputation. Environmental risks may impose fines or force capital expenditure. Social risks, such as labor disputes, disrupt operations. Governance failures lead to fraud, misstatements, or reckless leverage. Deterioration in ESG factors increases spreads because bondholders demand compensation for higher uncertainty. Describe how you assess off-balance sheet liabilities, leases, guarantees, pensions. You incorporate these commitments into leverage and coverage analysis. Leases behave like debt. They require fixed payments. Guarantees may create contingent liabilities. Pension deficits require future funding. Ignoring these items understates true credit risk. You adjust your model to reflect the economic reality, not just the accounting view. A company faces a large legal settlement. How do you assess the credit implications? First, determine the size and timing of payments. Next, assess liquidity. Can they fund it without additional borrowing? Then review covenants and ratings implications. A large settlement may trigger downgrades or covenant breaches. You consider how the settlement affects cash flow, leverage, and overall financial flexibility. Explain the difference between structural subordination and contractual subordination. Structural subordination occurs when creditors lend to a parent company that relies on subsidiaries for cash. Subsidiary creditors are paid first. Contractual subordination is created through debt agreements. Subordinated bonds agree legally to be paid after senior bonds. Both forms determine recovery priority, but one is structural, the other is contractual. How do you analyze distressed debt and evaluate whether a restructuring is likely? You study liquidity, covenant headroom, asset value, and short-term obligations. You test whether the company can refinance. Distressed issuers often lose market access. If liquidity drains and maturities loom, restructuring becomes likely. You model multiple outcomes: out-of-court exchange, Chapter 11, liquidation, and estimate recovery for each instrument. Describe key warning signs that a company is approaching default. Warning signs include rapid cash burn, maxed out revolvers, covenant pressure, short-term maturities with no refinancing, auditor going concern warnings, supplier disruptions, executives resigning. Defaults rarely occur suddenly. Signals usually appear months in advance. Walk me through how you monitor credit spreads and detect relative value opportunities. You track spreads across time, peers, and ratings buckets. If one issuer trades wider than similar credits without fundamental justification, that may signal mispricing. You also monitor spread moves after earnings, macro events, or rating changes. Relative value opportunities arise when spreads diverge from fair value. Provide an example, real or hypothetical, of forming a long or short thesis on a corporate bond. Here is a clean hypothetical. You find a BB-rated industrial firm with stable cash flow, declining leverage, and strong covenants. Its bonds trade wider than peers. You form a long thesis, expecting spreads to tighten as fundamentals improve. Conversely, if a company increases debt for an aggressive acquisition and liquidity tightens, you may form a short or underweight thesis. The thesis must connect fundamentals to expected spread movements. Explain how you present your credit views to portfolio managers, traders, and senior stakeholders. You tailor communication to the audience. Portfolio managers want conviction, catalysts, and risk scenarios. Traders want timing, liquidity, and spread direction. Senior stakeholders want clarity on downside risks and capital preservation. You use simple visuals, clean argument flow, and highlight the key drivers behind your recommendation. Communication is part of the job. A strong view must be delivered clearly to be valuable. Credit research is not about predicting growth. It is about surviving stress. This was a complete end-to-end interview preparation guide created specifically for credit research roles across investment grade, high yield, and distressed credit teams. If you followed this entire session, you now understand how credit analysts assess default risk, analyze liquidity and covenants, model downside scenarios, and translate fundamentals into credit spreads and recovery outcomes. Rewatch the sections on cash flow, leverage, maturities, covenants, and recovery. Practice explaining them calmly and clearly, because credit interviews test judgment under stress, not optimism. For more deep, role-specific preparation across credit research, equity research, risk, and markets careers, stay connected. And once again, do watch, revise, and master this material.